So Pakistan is quite unique in the sense that its banking exposure to government securities is exceptionally high, almost 4 standard deviations away from the median, right? So roughly almost 60% of all banking assets are exposed to government securities, which is extremely high by unusual by regional or even global standards. Obviously, as a result of this is that banks do not have much liquidity left to lend to sectors, economy at large, and let alone priority sectors. So right now, for the last many months, the advances to deposit ratios of the industry, which means basically how many rupee of loan do they give out for every rupee of deposits they have, has been hovering between 35 and 40%. So it's exceptionally low. And of that, only 10% eventually finds its way to the SMEs. So the result is that capital is very constrained to key economic sectors, whereas most of the liquidity is taken up by the government, which then, does whatever it wants to. So, we need to look at history to understand why banks have historically been the primary source of government borrowing. Even if not in Pakistan, broadly, banks have always had an important role to play. Pakistan's system, unlike some other markets, is highly bank-led, whereas in other markets you would have a variety of funds who are in this space. So that's one thing, but historically what these intermediaries did was they collected funds from one side, which is customers, corporates, and then deployed that capital into businesses or government. So there was, these intermediaries played that role, but obviously with technology, generally we have seen the role of intermediary declining, right? Across the board, marketplaces to an extent have done that. They've become bigger marketplaces and bigger intermediaries in the process, but nonetheless, it has streamlined the process. So Pakistan government believes in the same bet and has taken a number of initiatives to achieve the same goal. The question is whether that goal is worthy enough or not. How would you go about understanding this? One way would be that Pakistanis, a sizable proportion, or at least in terms of value, a majority of money deployed in banks is currently in savings accounts. And what really happens in savings account is that if I put in 100 rupees, those 100 rupees are being eventually lent to the government pretty much one for one. Whereas I get only at the current trade interest rates 10 rupees in interest annualized, the bank would be lending it to the government, let's say at 12. So that 2% becomes its spread. In theory, what if the government borrows directly from me, gives me 11%, it saves 1 percentage point, I save 1 percentage point, it's a win-win. So broadly, we are looking at 14-15 trillion of liquidity in savings accounts, which is a big number. It is larger than what's currently held in current accounts, which also is used to deploy eventually in government securities. And then the second part of that is money market funds. So whatever liquidity is going into money market funds finds its way back to the government securities. What if the government finds a way to directly capture that liquidity? So that is the broader logic. The question is if this is a worthy goal or not. It's still very early on, but there have been some success stories. For Pakistan, let's say a 15% share of retail in government domestic debt could potentially save up, let's say at 150 basis points, could potentially save up around 190, 180 billion, very rough back of the envelope calculations, which out of 8 trillion plus of debt servicing may not account for much. But we've seen in certain situations it has helped. It has helped create a buffer. A very good example of that exists on the external debt side, not the domestic, where Naya Pakistan Certificates through Roshan Digital Accounts have roughly around $1.5 billion parked there, and that makes up for 1.8% of external debt for the government, which is a decent number. It seems small, but it's a decent number. So the more important point is that retail investors are generally sticky. They do not move in waves, whereas an institutional investor essentially creates a concentration risk for any borrower. So the idea is very simple. Do not put all your eggs in one basket, and that applies to government securities. Whether that can substantially reduce, let's say, our interest cost by 50%, probably not, but drop by drop. All these schemes have tried to cater to a very different audience. If we start with national savings, it has been the earliest instance in Pakistan for tapping onto the retail investment segment, and you could argue that it's been a fairly successful scheme, depending on how you define it, how you define success or how you measure success. The way at least I think of national savings scheme is more from a social security lens. NSS is not really, in the truest sense, a market-based saving instrument, right? Their target audience, a large chunk of it happens to be widows, retired people, elderly citizens, people maybe who sold their plot and want some fixed return every single month to run their kitchen. That's typically or traditionally has been the primary base of national savings schemes. And with technology, I don't think, NSS has not really adapted, even though there have been a few changes over the last 5-7 years. The experience still nowhere close to what you would find in an average bank, which again is not really that good. So part of the problem there is technological, and the other part of the problem is the demographic. It looks at the highest age bracket, basically 60+1 on average. The other is RDA. RDA, one can argue, has been the most successful of all the schemes. There have been, for roughly around 2 years, due to political uncertainty and whatnot, our RDA and NPC's share in the external debt kind of dipped, but it has been recovering again for the past many months, and it has given like a $1.5 billion buffer. So I think that's been a fairly successful or somewhat successful scheme. There is room to further double down on it, and I think what we see in recent policy changes is that this thing is already happening. Very recently, the State Bank opened up NPC to Real and dirhams, so which is a good initiative. And then you have the IPS, right? IPS is one of the oldest, not one of the oldest, but post NSS. It's been around for like 13-14 years now. IPS let me invest directly into a government bond rather than parking that money into a savings account. Unfortunately, IPS was arguably the least successful, because even if you try this today, go to a branch, ask them to open an IPS account, there's a high chance that the branch people will not be familiar. They'll try to sell you insurance or mutual fund instead, not IPS, where obviously there is a high deduction in the first year in the form of front load or in the form of sales commissions and whatnot. So IPS has been the least successful, but I don't think there's a behavioral issue. If someone is parking, everyone likes more money. If someone is parking their funds in a savings account in the hope of getting return, part of the reason is convenience. That is one part. The second part is obviously that savings accounts do not have a fixed tenor. But even in that case, there is 3 to 4 trillion of liquidity available in fixed deposits, which should in theory be ripe for government bonds. Now, whether the government can actually tap onto that through a decent enough product and a proper distribution is the question. Recently, again, there have been attempts. Invest Park has been one such instance, but I mean, progress still it still falls short of where it should be. Generally, the simplest answer is make the solution as convenient as possible, right? The user experience should be seamless, and unfortunately, that hasn't been the case. If the intermediary is going to be there, whether it's a bank or a fund, then the marketing has to be on point as well. Their staff should be clear. There should be penalties in case the staff is not familiar, which we've seen in a lot of government-backed initiatives, that the intermediaries either avoid that, they have an incentive to basically avoid it, but there should be sticks to make sure that they do not evade customer responses, they do not try to treat that product as a step kid. So I mean, that's one thing. The second part is the Sharia aspect. If we see in the more recent periods over the last few quarters, in terms of digital onboarding of accounts, we see Islamic accounts surpassing conventional in every single period for the last 4-5 quarters. So I think whatever product is there, we see that in Naya Pakistan Certificate as well. The capital held in Islamic instruments is far ahead of what's in conventional. So I mean, there is a market has responded. The question is, how does the government design a product that is catering to their needs? So I mean, again, whether it's an intermediary led or not, that's, I mean, really not the question. The question is, are people willing to invest? Yes. And the third part would be, who is the target audience? Historically, it has been, right, historically we've looked at in NSS, the relatively older generation, and with Naya Pakistan Certificate, we have seen overseas Pakistanis. But is that the is there another liquidity pool? Maybe some people around 30 to 35, people around 40 to 45, or whatever the age group that may be. So the product has to be designed as per their needs.